Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Syding. Today I'm going to share a little bit of my private equity portfolio. I've given you run-throughs and valuations and reasoning behind my investments in a couple of publicly listed equities, but I also have a much larger portfolio of private equities. So let's start with my investment in Polskenet. So Polskenet is an investment company. It was started by me and a couple of friends, including around 20 or 30 other investors. So what we did was uh, pool some money and form this investment company with the business idea to start acquiring smaller companies, streamline them a bit, put it all together in a larger conglomerate, and sooner or later just live off of the dividends from these companies, or perhaps list the company as a public company on a stock exchange. So a typical timeline for an investment like this is about 10 years. So I did enter into this investment about 10 years ago. I started by putting a little bit of money in it, about $500,000. And then over time, I've put in about $1.5 million in total. I would say that the actual value of this company, my holding of this company, is about $10 million yeah, today. I might not exactly get that if I was trying to sell it, but I fully expect that in, let's say, 3 or 4 years' time, when we do list it publicly, if the environment is the right one, it should be worth about $10 million. It's a good investment. It's a long-term investment. And how does it really work? I mean, how is it even possible to make that kind of money from something that actually, in a way, is pretty low risk? Well, the thing is that this is just financial mathematics. What you do is you take, let's say, $100, and you add on top of that another $100 in debt. Now you've got $200 that you can acquire companies for, and you acquire companies on the private equity market for about half or even a third of the multiples that you get on the stock exchange. And these companies that you have bought, you can actually make them even more efficient and make them grow their profits even better than before. Or you can tell them best practices in terms of cash flow management, making them throw off more cash flow than they did before, making your real acquisition multiple even lower than the half to a third of the publicly listed companies. These companies that you have bought, they in turn generate cash that you can leverage up by borrowing against that cash as well. So for every 1 million in profit or cash flow that you get from your acquired companies, you can borrow another million and then use those 2 million to buy new companies. So and this process it just goes on and on in a compound interest kind of way that is not only compound interest, but you also get the two added extra effects of one, using leverage. You can buy twice as much as you actually have money. And as long as the borrowing rate, the interest rate that you pay on your loans, as long as that's lower than the return on equity that you're getting from your acquired companies, then this is like a really money-making machine. So just to make it a little bit more tangible, typically when you pay these low multiples of, let's say, 6 to 7 times earnings, that's the same thing as that company that you're buying are making somewhere between 15 and 20% return on your equity invested. And considering that you actually buy twice as much for your money, that amounts to, in effect, a 30 to 40% return on equity on the money that you are putting on the line. And you have to, of course, deduct your cost of borrowing. Let's say that that is 6%, a 6% cost. So from the 30 to 40%, that's called it 36%. You have to deduct a 6% debt cost. Now you're down to 30% return on equity, which is a huge return, especially if you start uh, calculating the compound effect over 3, 4, 5, or 10 years. And that's why an original investment of, let's say, $1.5 million in the pretty short amount of time, like let's say 10 years is, can turn into $10 million. And this is the beauty of private equity investment. As long as you are ready to um, for this zero liquidity that you have in a private investment, then you get the double beauty of being able to buy very cheaply, leverage it up, and then uh, um, listing it publicly and then getting the typical public equity valuations. So there is this compound effect and the leverage effect and the multiple expansion effect that creates this yeah, immense return opportunity. And that's why as soon as you can get your hands on private equity investments of this kind. I'm not talking about typical tech startups where you have to go from 0 to 1. I'm talking about this kind of compound serial acquisition companies that are run by very experienced managers that have made these type of acquisitions before and that are good at creating a rapport with the people that you want to buy companies from. Because otherwise, you will not be able to both ascertain the quality of the companies and that there's no fraud going on, and also making sure that you actually do get to acquire them these low multiples, rather than they having a better rapport with some other acquirer and letting them buy their company, their life's work at these cheap multiples.